In today's discussion, we are diving deep into the current situation surrounding the phenomenon of short squeezes and the pressure being exerted on short hedge funds. Over the past few days, we have witnessed a remarkable uptick in the prices of heavily shorted stocks, putting immense strain on these hedge funds, and there is growing speculation that this pressure may ultimately lead to the downfall of some of these funds. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone remember, this is not a financial advice video. To set the stage for our discussion, let's start with a tweet from Kevin Malone, which suggests that a major short institution had to commence covering its positions recently. He shared a screenshot that listed a variety of small-cap stocks, many of which are heavily shorted. What's intriguing is that these stocks experienced significant gains in just one day, with some surging by 10%, 20%, 30%, and even a popping 47%. Notable names among them include Carvana, Affirm, Upstart Holdings, Nikola, and Coinbase. These stocks fall somewhere between traditional blue-chip stocks and meme stocks, characterized by their substantial short interest. When short hedge funds come under duress, their initial response is to close short positions in prominent blue-chip stocks, often triggering upward movements in stocks like Nvidia and Tesla. As the pressure intensifies, they turn to the heavily shorted stocks in an attempt to salvage their positions, with the meme stocks being their last line of defense. The reasoning behind this strategy is clear. They know that closing their meme stock shorts would be catastrophic, not only for their fund, but also for other players in the industry. Therefore, monitoring their actions in heavily shorted stocks like Carvana, Affirm, Upstart Holdings, Coinbase, and others can provide valuable insights into the overall stress levels of short hedge funds. The recent surge in these stocks indicates that a particular institution might have liquidated its short positions or initiated coverage. The evolving situation over the next few weeks will undoubtedly be intriguing to watch. However, it's crucial to emphasize that what we are currently witnessing is just the beginning. We've seen similar scenarios unfold before, like in June and May, when stocks like Carvana and Upstart experienced meteoric rises. Carvana, for instance, saw its stock soar from $6 per share to nearly $60, marking a tenfold increase in just 2 months. Upstart had a similar journey, jumping from $11 to $72 in the same time frame. Over the past few days, we have observed the early stages of another potential run, with Upstart and Carvana already breaking out. This raises the question of how high these stocks can climb in the coming weeks and how many short hedge funds will be forced to close their positions in heavily shorted stocks. If things spiral out of control, it's highly likely that they will be compelled to cover their meme stock shorts as well. According to JP Morgan data, hedge funds have been aggressively shorting the current stock market, with short positions rivaling those seen in previous episodes in June and July. This escalation suggests that if the rallies in stocks like Carvana, Upstart Holdings, Affirm, and Coinbase continue, the situation could intensify even further. Switching gears to another interesting development, you may recall the Canadian hedge fund that made headlines recently. This hedge fund was banned from trading by Canadian regulators after causing substantial losses to market makers due to a high volume of FTDs failed to deliver. Tragically, the fund's founder was discovered deceased just 1 day after the ban. Virtu, one of the market makers affected by these losses, is now suing Trainer Ridge Capital, the hedge fund in question. Virtu alleges that Trainer Ridge failed to provide the necessary funds for trades that Virtu executed on its behalf. Virtu ended up with significant losses exceeding $5 million as a result. The rapid transformation from normal trading activities to such significant losses and the founder's untimely demise raised numerous questions about what transpired at Trainer Ridge and the potential reasons behind these substantial losses. In addition to these developments, we have the case of Sam Bankman-Fried, who has been found guilty on all 7 charges and now faces a potential maximum prison sentence of 115 years. The intrigue here lies in what Sam's next steps will be and whether he will cooperate with authorities by providing information about individuals higher up in the hierarchy. This cooperation could potentially lead to a reduced sentence for him, possibly as low as 5 to 10 years. The outcome of his prosecution will shed light on the extent of his involvement and any potential dealings with influential figures in the financial industry. Lastly, it's worth highlighting a recent case where a prominent hedge fund, Prophecy Asset Management, was charged by the SEC for engaging in a multi-year fraud scheme. This scheme involved concealing losses of hundreds of millions of dollars from investors, auditors, and administrators. The fund's president and CTO, John Hughes, and his associates were accused of misleading investors about the fund's trading practices, risks, and performance. They resorted to various tactics, including manipulating financial records, misrepresenting assets and liabilities, and falsifying securities transactions. The SEC's complaint reveals that the fund, which reported over $500 million in assets under management, had concealed losses totaling $350 million. The fraud was only discovered when redemptions from investors were indefinitely suspended. This case serves as a stark reminder that even seemingly reputable hedge funds can employ deceptive tactics to hide substantial losses, potentially running into the billions of dollars. It raises questions about the accuracy and reliability of financial reports and the extent to which auditors can be deceived by such fraudulent activities. In conclusion, the financial landscape is filled with intriguing developments and challenges, from the ongoing short squeeze saga to legal proceedings and instances of financial deception. These stories serve as a testament to the ever-evolving and often turbulent nature of the financial world. As these narratives continue to unfold, we can only wait and watch to see how they shape the future of the markets and the financial industry as a whole. Guides, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.